Welcome back, everyone. This is Dr. Hisham Said. This is the second part of the lesson about loans, borrowing, and lending. And the last part of this series of videos, I showed you how it's important, why it's important to know about the different parts of the payments for repaying back a loan. So there's a part that covers the interest, which we call here the interest payment, and there is part that covers the original amount that is borrowed, which is the principal payment. And we did this exercise for an example that Sally here borrowed the 10,000, and then we need to figure out first how much to be paid in every year of the 4 years in the agreement. So we came up with this value, and it's repeated here as we see. And now we did this exercise to see over each year how much is paid for the interest and how much is paid for the principal. So when you deal with the tax return, you report that I paid for these, and every year you know how much you paid for interest, and this should be deducted out of your taxable income. So now we don't have to go through this exercise to figure out the information about the taxes that you paid and different values for the loans and paying back loans. So we'll use formulas starting with the unpaid balance. So at any point of time t, you can calculate what we call the unpaid balance, which is at the end of each year or any year t. It's the value immediately after making the current payment. So it is the value of the balance after making, so this is important, after making the current payment. So this is the formula for it, and I will just show you how to calculate this. You don't have to memorize it. Of course, you will have this available in your note sheet in the exam or the midterm. But to show you that this actually can be proven by looking at the cash flow that we have. So I will draw here an example cash flow. So if we have the loans are paid back, for example, the example of the loans of 10,000 and then paid back in 4 payments. And this the question here is asked at the end of the second year, what should be the unpaid balance of the payment here? And the last exercise we figured out that A equals 315.4.7. So at the end of the second year, we're done with paying the first payment, and we're done with paying the second payment. And now we need to figure out how much is the unpaid balance, which is equivalent to these 2 payments that are not made yet. So these will be done in the future if you keep having the loan active and paying it over the coming 2 years. But now the unpaid balance will give you an idea if you want to pay now, how much is equivalent to these 2 payments. The future 2 payments. So it's now visually you can see that the unpaid balance of these 2 payments, so unpaid balance equals the present value at t equal to for the future payments, for these future payments. So the present value of future payments, and we see here you can say it's annual years. So now I'm dealing with a present value of annual years. It's the same interest that is in the agreement, and then the number of payments is n minus t. So at t equals to 2, then n minus t equals, n is the original number of the payments, minus 2, so it equals 2. So we can see here that this formula is not just coming by parachuting to us. You can prove it by looking at the cash flow and then thinking of how much is the unbalance at the end of the second year. So the unpaid balance, at the end of the second year, which should be equivalent in value as the present value at this point to the future payment that they are not made yet. So it's the present worth of annual I%, and then n minus t, 4 minus the 2 that you made before, then it's 2 remaining, and you calculate the value of the unpaid balance. The unpaid balance at the end of the second year, you don't have to do all that. You have the formula for now. You know how we came up with it, but now you say the unpaid balance at the end of the second year equals the A, which is the amount of paying back the loan in the equal amount that you pay in every year for the loan, which is here equal the amount we mentioned before, 3154.7 multiplied by P given A. I here is 10%, and then n minus t is 2. And we mentioned before, n minus t equals 4, the number of original payments of the loan, minus t, which is the time I'm currently evaluating the unpaid balance. So you will calculate that 3154.7 multiply the value of the factor here is 1.73554. And how to get this value? You get it from the tables or using the formula. So at the end, the result here, the unpaid balance at the end of year 2 equals 5475.1. And of course this is dollars. And if you compare this result to the value we had before, you will find in the tables, the detailed calculations, you will find it equal to this value, which is the unpaid balance, or the beginning balance. The balance at the end of year 2. Okay, so keep moving now we're done now with how to calculate the unpaid balance. Unpaid balance, which is the payoff. So payoff is related very strongly to the unpaid balance, because now we see it is a function of the unpaid balance. So if you want to pay off all the loan that you have, including the current payment for this year, T, it equals the current payment, which is equal for all years, A, plus the amount that is equivalent to the future payments, which we define it as the unpaid balance. And now we see here it equals, now A is a common term, so you take it out, and then it equals A multiplied by 1 plus the factor that we used before to calculate the unpaid balance. So if now it's a matter of applying it to calculate the payoff at the end of year 2. So we use the formula here. So payoff at year 2 equals A, which is equal to the same value we calculated and agreed on the loan agreement, multiplied by 1 plus the factor here, P given A, 10%, and then n minus t, again it is n minus t equals 4 minus 2. 4 is the number of payments for the loan as a total, and then 2 is the current time I'm evaluating how much to pay off for the remaining payments. So this is 2. So you calculate now this one factor, or you get it from the table. So it equals 1 plus, and this factor here we used it before, 1.73554. So you get here that the payoff at the end of year 2 will equal $8,629.8. So this is the amount that if you decide, or Sally decides, to pay off everything on the loan after paying the first year, and then at the second year she's evaluating, beside paying the regular amount, or including this amount, how much now to pay for everything. So this 8,000 includes the amount that she would have been paid as regular, plus the future value of the payments that she will make if she continues paying for the loan. So this is the end of the second part. We covered now two values that we can calculate for a loan: the unpaid balance at any year and the payoff also at any year. So we still have another part, a third part that will in this series of the loans lesson. So keep sticking around, and I will see you in the third part, or the third video of this lesson.